Imagine you're standing on the edge of a diving board. Below you, the water looks inviting, but maybe a little intimidating. Now think about your feelings at that moment. Are you excited, ready to leap, or do you feel a knot of anxiety in your stomach? This moment is a perfect metaphor for risk tolerance in investing. Just like deciding whether to jump, investing is fundamentally about understanding and managing risk, your appetite for it, and your comfort with its potential ups and downs. Risk tolerance is personal and unique, like a financial fingerprint. It's about how much uncertainty you're willing to handle with your money. When we talk about investing, we're talking about using money in a way that could lead to greater financial growth, but also comes with the chance of losing some of it. It's a bit like planting seeds in a garden. You're hoping for a bountiful harvest, but there's always a chance that not every plant will thrive. Let's bring in an analogy from the world of sailing. Imagine you're setting out on a journey across a vast ocean. Some people are perfectly happy in a small, nimble sailboat, keen to feel every wave and gust of wind. Others prefer a large, stable yacht that smooths out the journey. Your comfort on this ocean journey is akin to your risk tolerance in investing. Some investors are like the small sailboat, ready to embrace the waves, confident in navigating through market volatility. Others, perhaps with more at stake or a less adventurous spirit, prefer the stability and predictability of the larger yacht. In the financial world, risk and reward are closely related. The greater the potential return, the higher the risk you often have to take. It's like playing a game of basketball. The more you practice shooting from long distances, the better you might become. But there's also a higher chance of missing those shots compared to safer, close-range shots. Now, you might wonder, how does one determine their risk tolerance? It begins with understanding yourself, your financial goals, your need for returns, and your comfort with the potential of losing money. It's about asking questions like, how would I feel if my investments lost significant value? Can I handle seeing red in my portfolio for a while, knowing that markets can rebound? What is my timeline for needing to access this money? The longer you can leave your money invested, the more risk you might be able to take, since there's more time to recover from potential downturns. Think about the emotions that money triggers. Fear and greed are big players in the world of investing. Fear can make you sell hastily when markets dip, while greed might tempt you to chase high returns without considering the risks. Understanding these emotions and recognizing them as they arise can help you make more thoughtful, disciplined investment decisions. As a personal example, I remember the first time I encountered a market downturn. I felt a rush of anxiety, fearing I had made the wrong choices. But over time, I learned to see downturns as opportunities to buy more at lower prices by remembering my long-term goals and my initial tolerance for risk. Markets are a complex web of human behavior, and our instincts can often lead us astray. That's why a balanced approach to investing is crucial. Diversification, spreading your investments across different assets, can help manage risk. It's like not putting all your eggs in one basket, so to speak. If one investment loses value, others may gain, helping to balance out your overall portfolio. Building wealth is often a marathon, not a sprint. It's about making smart decisions today that help you reach your goals tomorrow. Risk tolerance isn't static. It evolves with your life stage, financial situation, and even your own experiences with investing. Sometimes taking a step back and reassessing your risk tolerance is just as important as the investment choices you make. In the end, finding your sweet spot with risk is about knowing yourself, both your emotional landscape and your financial objectives. It's about being realistic about what you can handle and aligning that with a well-thought-out investment strategy. So next time you find yourself standing on the metaphorical diving board, take a moment to reflect on your willingness to leap. Let your understanding of risk guide you, and remember that just as in life, In investing, it's often about the journey, not just the destination.